I'm just going to introduce myself real briefly. My name is Beth Manley. I'm the Adult Financial Education Manager with the Franklin Mint Federal Credit Union. My background is I have an education degree, and then after graduation, I ended up getting a job in finance, and I did a wide variety of jobs for a captive finance source for about 14 years. Literally everything from customer service and collections and repossessions and post-charge-off collections and managing teams, and then going into financial sales and contracting and auditing and things like that. So if you want to know something about a car loan, I'm definitely a pro. I was also a credit analyst, both wholesale and retail, for many years. So understanding the individual's needs for financing and then also the dealership's needs for financing on a grand scale was part of my job. When the economy went downhill, for lack of a better term, I ended up moving into retail banking, and I've been doing this for about 10 years now, and again was helping people with credit counseling and understanding loans and retail banking accounts, things like that. And then there was this opportunity. As a credit union, we are a non-for-profit financial institution, and that is an important distinction. We do everything that a bank does, but that non-for-profit cooperative status means that we have a different driver. Our driver isn't our shareholders. Our board is not a paid board. We have a volunteer board that helps direct what we do. And the money that we earn beyond sustaining and growing ourselves at a reasonable rate goes back into our communities. We have about a dozen people employed in our community education department. We're all educators with a finance background, and we have 23 different schools that we go into to teach K through 12 students about basic banking because it's lacking in our curriculum currently. There is this career readiness that is coming into Pennsylvania that went into effect last year, and now the schools are scrambling to try and provide this curriculum and on all the things that go with it, and we're here to help them because we already have it ready to go for them in a meaningful way. And then I handle all of our adults. So we have different partner groups, everybody from Mainline Health to Drexel University, Swarthmore, the YMCA, and sometimes I am presenting a variety of topics to their employees, and sometimes I'm presenting to the students. So today's topic is budgeting and banking 101. So we're gonna go right into the budgeting aspect of it, and we're gonna hit on a lot of different components of budgeting, from the emotional portions of it, which we underestimate, to the actual ratios to judge if you're healthy and if things are in balance in regards to your finances. With Banking 101, if you are unbanked, meaning you don't have a financial institution, you're not quite sure, maybe it was something that your family handled for you for a really long time, maybe you are not a native of this country and you haven't realized that American banking is about 25 years behind European banking as far as how we handle things. We're still writing paper checks as opposed to using a chip for everything. We're going to touch on that a little bit and why you need certain accounts and how to manage certain accounts, but that's going to be a real brief portion. If you have deeper questions about that, I will have my contact information. You're more than welcome to reach out to me, and I can send you more resources. And again, we're going to mainly do a deep dive into budgeting. There's a copy of the presentation here for you. You can take notes. In addition to that, there is a basic budget outline on the back, and then there is some tips and tricks for the balancing of the budget that we're going to talk about very briefly. So again, we're going to talk about why we need to budget, making financial decisions, defining realistic financial goals. Goal setting is important when we're talking about budgeting. Goal setting is important when we're talking about any aspect of our life. Being financially healthy and what that means. When I talk about FIs, financial institutions, I'm meaning banks or credit unions. It's kind of the broad term. It encompasses more than just banks and credit unions, but generally when we say FIs, that's what we're talking about, your everyday banking. And then avoiding unnecessary costs that can creep up on you if you're not aware of your habits when it comes to banking. So a budget is telling your money where to go instead of wondering where it went. It's not flying by the seat of your pants. It's having a plan. It's monitoring your spending. I'm going to say this over and over again. It's mindfulness over mindlessness. When we are mindful in what we do on a daily basis, we move in the direction that we want to. So a lot of times we think we have to have a budget because we don't have enough money. And this was a big eye-opener for me. It's not just about having enough money. So 60% of NBA players are broke within 5 years of departing the league. And 78% of former NFL players experience financial distress within 2 years of retirement or leaving because of injury. These are individuals who within 1 year are potentially making more than any one of us is going to make in an entire lifetime. And because of lack of planning, because of not understanding how money works and how to make money work for you, they're broke within just a couple years of losing that income. We have to have a plan. The old adage, fail to plan, plan to fail. So what we're really talking about is the difference between being impulsive, between having spending freedom and that instant gratification, having that plan where we have financial freedom, where we're not just thinking about today, we're thinking about tomorrow. You know, we're here, we're getting an education, we're thinking about our futures. Well, there are a lot of different components that go into that planning of the future. And budgeting and figuring out what your financial needs are and your habits are a huge part of making sure that your success is all-encompassing. It's rewarding yourself for reaching goals, and most importantly, having those goals in the first place and having a plan in place to meet them. And building wealth and financial stability so that emergencies are less of a problem. So let's talk about budgeting. Basically, a budget is just made up of these three parts. It's your income, your expenses, and your savings. Your income can come from many different sources. Your income could be a stipend. It could be a part-time or full-time job. You could be fortunate enough to have an investment property that somebody is paying you rent, and that's a portion of your income. It's any money that's coming in to satisfy your wants and your needs. Expenses. This is where we get a little bit lost because we only think about the big expenses. You know, our groceries, our mortgage, or our rent, our car payments. We don't think about the fact that we are maybe getting $20, $30 in spending money out of the ATM, and then where is that money going? We're not monitoring it. Our petty cash just becomes unimportant. And that can really erode the different financial goals that we have if we're not keeping track of every single cent. And then our savings, the whole pay yourself first. One of the biggest financial mistakes that I ever made was when I got my first big job out of college, I waited 5 years to participate in my employer retirement plan. I had student loans, I was out on my own, I had all these other expenses, and I just didn't see, because I had a pension, which almost no one has anymore. I had a pension, but I also had this employer plan that I could participate in. I estimated now, with what I had saved, because I was with them for quite some time, and then I've had subsequent employers, if I had just put away 3% during those first 5 years, based on how my money has grown and what I was earning, as of right now, I'm at about $80,000. That's in today. By the time I retire, because I'm probably going to retire at around age 70, I will have been out about $250,000 based on the performance of that money. So while 3% back then seemed like so much money, it's so much more now. And that's the power of planning, the power of being able to see down the road and plan for things that you want down the road instead of just being focused on every little thing that's happening today. You can't do a budget overnight. It's not realistic. I say to start with, give yourself 30 days. So what you're going to want to do is you're going to want to start being mindful of your habits. You don't necessarily have to change your habits right away. Kind of benchmark what you're doing. When you get that 30, 40, 50, whatever you plan on spending as your regular spending money, your running around money, keep track of everything that you're spending it on. Whether it's, you know, a cup of coffee at Joe's or Starbucks, or it's lunch at one of the food trucks, start marking it down, writing it down, keeping receipts. And at the end of that 30-day period, that's when you're going to gather your receipts and you're going to kind of get an idea of the big picture. And there may be things that don't necessarily come up every month. And that's where, once you get your baseline, you can start projecting into the future a little bit more. If you have car insurance and you pay your car insurance every 6 months, you need to figure out your pay cycles aside every single pay cycle in order to have the money available to you when that bill comes due. And that's the power of budgeting, because if you're not doing that, then when that large bill comes due every 6 months, you're going to be in panic mode trying to figure out where you're going to find the money for it. We see this, unfortunately, a lot with people who've paid off their mortgages. If you're not already a homeowner, you might not know that every year you pay property taxes, and that can be a really, really large amount of money depending on where you live. It could be $1,200, it could be $12,000 or more dollars, depending on the value of your home and where in the area that you live in. So a lot of times we have people who they're great, they're doing well, they're financially stable, and they pay off their mortgage. Well, your mortgage typically includes your property taxes. You're paying that each month, and you get used to the ease of doing that. So suddenly your mortgage is no longer an issue, and you're just spending this money without thinking of it, and then your annual tax payment comes due, and you're scrambling if you haven't planned ahead. People who are smart, people who are looking ahead, have a savings account. They're taking the portion that they were paying monthly for their mortgage payment that was for their taxes, and they're putting that into a savings account so that they are prepared when that bill comes due. Your method of choice for tracking your spending is really up to you. This is really whatever you're comfortable doing. There are some great apps out there for managing your money and budgeting. I've seen people use Mint before. There are different versions of a lot of these apps, and this is one of those things that you need to kind of, from a consumer point of view, be aware of. If something is free, you are the product. So if you're using a free budgeting app, if you're using things like Credit Karma or anything where your financial information is being gathered, understand that there's a huge value in that. And while you're being provided the service for free, your data is also being sold and used to market to you. So if you're using things like Credit Karma and you've got a lot of credit card debt, or using Mint and you have a lot of credit card debt, then you're probably going to start seeing ads for debt consolidation, because you're the target audience, and now we know that you're the target audience. So if that's not something that you want to participate in, then you may be better off buying and paying money for an app that's going to help you so that your information is not being shared and marketed. I have provided a copy of the basic budget starter for you, and this is just to kind of get your mind going as far as all the little things that you might not remember. We get into this mindset of automating so many different processes that we tend to forget about what we're actually doing. Maybe you have online gaming that you have automatically coming out of your checking or savings account. Netflix, gym memberships that we never use. All these things, when they automatically sweep out of our account, we end up having an aspect of mindlessness with them. Make sure that you're accounting for those things and budgeting for them properly. It could even go a step farther if you've got a lot of apps that are sweeping through your checking account, things like Venmo or Uber. Every time you use Uber, it just sweeps out of your account, maybe it's charging on a credit card, and you're not being mindful of what you're spending. Make sure you're looking at your account, not just your receipts, so that you're keeping track of everything over the course of that month. So now here's where the emotional part comes in. Did you have a question?
Yeah, I also just wanted to say that you need to keep looking at your account to monitor possible fraud.
Oh, absolutely. Absolutely. You have a limited amount of time. If you see something on your account that's fraudulent, you have a limited amount of time. It's typically 60 days from the date of the activity to report that to your bank, your credit union, or your credit card company. If you let it go too long, then you have no recourse and you will not get that money back. And that 60-day window is universal. Thank you for bringing that up. Absolutely. So don't underestimate the amount of emotion that is tied to how we spend and use our money. We can say and know, we shouldn't spend money on this, we shouldn't spend money on that. But yet we fall into these patterns of behavior for a lot of different reasons. Some of it's cultural, some of it's the way we were raised, it's our family, it's the friends that we hang out with. Some of it's impulse control. We need to get down to exactly what is a need and what is a want. And that should be the basis for all of our budgeting. And there are some gray areas there, and that makes it even more difficult. So there are plenty of people that would say a cell phone and internet is a want and not a need. There are a lot of people that would argue that you can't get around in a modern society without those two things or access to those two things. So you have to decide for yourself, what is your opportunity cost? When you make a decision and spend money in one area versus another, what are you willing to give up to make that decision? To determine if it's a need or if it's a want. Because realistically, if you can live safely and with dignity without the purchase, if you lost your source of income and you wouldn't keep spending money on this item, or you can live without the purchase for at least 6 months, it's a want, it's not a need. If you can use that when making especially larger decisions, I say transportation is probably one of the hardest, because living in the city you can get away with using public transportation for the most part. If you're outside the city, if you're in the suburbs, then you really do have to make the decision if you're going to buy a vehicle. And that's when you have to decide between, do I want the basic transportation that's going to get me where I need to go, or do I want something flashy? Am I going to spend more money and get something that I really, really like? And then it snowballs. And we're going to actually go into detail about the purchase of a car and all the things that you need to take into consideration when you're making some of these big purchases. Buying a house. Do you buy a basic house that you need, a starter house? Or do you get the house that you're going to grow into? Well, are you looking at all the different things that are associated with that purchase? And then there's our values. What's important to us? Is our spending in line with what we say is important to us? If I say that spending time with my family is important, but yet I go on shopping sprees and ring up debt so that I have to work overtime so that I don't get to spend time with my family, are my behaviors in line with what I'm saying are my values? And this is a personal thing. This is not a judgment call with, maybe these things are important to you. Well, that's fine. Just make sure that the decisions that you're making in your life to maintain that lifestyle are taking you down a path that you want to go. So now we're going to talk a little bit about goal setting. Goal setting and the formula that we're going to talk about really works with any aspect of your life, whether it's a fitness goal, an education goal, or a financial goal. You have to identify your priorities, and as far as money goes, ask yourself, why is money important to me? What is money going to get me that I want? Because money is not an end to itself. Money provides different things. For some people, it's about power. For some people, it's about freedom. Maybe you're somebody who wants to have that big house. Makes you feel important. Maybe you're somebody who wants to be able to retire at the age of 50 and travel the world. And having that big house is never going to be a priority for you. That's about what you value and what's important to you, and using money as a means to get there. How do you want to live? So here's the chart. And you may have seen this before. Your goals need to be SMART. They need to be specific, measurable, attainable, relevant, and time-bound. So, I'm going to save money. That is not a SMART goal. That is a wish. There is no plan associated with that. I am going to save $500 by putting $12 a week aside from my paycheck from January to the end of November so that I have money to buy gifts for my friends over the holidays. That is a SMART goal. The difference is, it's relevant to me, I can monitor it, it's attainable. If I'm 6 months in and I haven't saved half that money, I can benchmark it, see where I am in regards to my goal, and I can make changes to my behaviors in order to address my shortfalls. You can keep track of it. Saying, I'm going to get in shape this year, that's a wish, that's not a goal. Saying that I'm going to stick to a diet and monitor my calorie intake so that I maintain no more than, 1,500 calories per day. I'm going to work out 3 times a week, a minimum of 1 hour, so that over the course of 1 calendar year, I lose 30 pounds. That is a SMART goal. That hits all of these components, and you can track it. You can see if you're on target. You can make adjustments. If you don't have all of these parts to your goal, then the likelihood of you reaching it is very slim. One of the things about goals is that if all of your goals are long-term, if your only goal is to retire a millionaire, you're probably not going to get there, unless you're one of those rare individuals who's completely focused on that one goal. We lose our enthusiasm when something is too far into the future. I always liken health goals to money goals. So if you've ever used any of the, like the Weight Watchers programs or the Jenny Craig's, any of those, they all have these quick start options. And your financial goals need to have a quick start option too. Start small. Have a goal that you can reach within 6 months to a year so that you stay focused on that, you get the thrill of achieving that goal, and now you can move to the next step. So that's why we say have your short term, your emergency fund, maybe saving for a vacation, maybe paying off a debt, a small debt that you have. Maybe that's your short-term goal. Then midterm goals, maybe saving for a down payment on a car or a house, paying off your education or saving for your children's education. And then everybody's long-term goal needs to be retirement so that you don't have to work for your entire life. So just as an example of what having a goal and being focused can do, I put together a vacation. So if you save around $38 a week over the course of a year, you can do a 4-day all-inclusive resort. It's a good resort too, I looked at the reviews, in Cancun, and that included a round-trip nonstop airfare from Philadelphia. That's for 2 people, so $38.12 a week. So the average Uber ride is about $13. A mid-priced, no, this is not in the city, a mid-priced meal without alcohol for an individual without dessert either, runs about $28. Domestic beer is about $5 on average. So think about, a movie ticket, $12, if you're lucky, $12. Think about all the little things that you spend money on during the course of the week, and how many of those things could you curb or maybe do every other week to end up being able to meet a goal like this over the course of a year? You know, maybe not going to the movies, maybe renting it out of, or streaming it out of Netflix every other time is going to be able to save this money for you so that instead of just going to the movies every week, you can now go on a nice all-inclusive vacation with your partner. Opportunity cost, spending the money and not thinking about it versus having a plan and being able to reap the rewards of having that plan. This is one of my favorite quotes when we talk about budgeting. It's from our buddy Ben Franklin. Beware of little expenses, a small leak can sink a great ship. I did not realize how mindless some of my own personal habits were until I started sitting down and actually budgeting for myself. About a year or 2 before I took on this position within my company, I was looking over my spending and I'm like, where is all my money going? I mean, I was paying my bills, I wasn't having any issues, but I wasn't saving as much as I should be saving. I'd get to the holidays and I'd end up charging all my holiday gifts and then I'd have to spend the next 3 months paying them off. Like, I'm a grown adult, I'm making enough income, I shouldn't be behaving in this way. Where is my money going? So we have this nice budgeting software on our website, and I looked at the breakdown of my spending. And there were 2 things that were glaring. The first thing was, I was working within one of our hospital branches, so we had a cafeteria. So every day I would spend $1.50 and I would go and get a cup of coffee, and then typically I would eat lunch at the cafeteria because it wasn't expensive, it was about $5. So between those 2 habits, doing that day after day, I was spending the equivalent of my car payment on lunches and coffee. And then I started looking at some of my other spending habits. And I don't know if you like Target as much as I do. I have a bit of a Target issue. I would do what's called the lap. I would go in for literally nothing but kitty litter and cat food. I would do the Target lap, and I would spend $100. Well, you do that 3-4 times a month, and you're spending a significant amount of money, and you're not realizing it. You're picking up little things here and there, and you're not realizing how much money you're spending. So I needed to find alternatives to those two habits. So which of these are your habits? Because some of these can get really expensive very quickly. My favorite now, these are national averages. If you're in the city of Philadelphia, a lot of these things are a lot more expensive, like the soda, lunch. I mean, $7.40, that's like Chick-fil-A. I mean, if you want to go to a Smash Burger, or what is it over here? It's like Shake Shack, thank you. Shake Shack, I think it's more like $12 for like a burger, fries, and a drink. But just cigarettes. You're not going to find a pack of cigarettes for $7 in Philadelphia. That's more like $10 to $12. You're doing these things day after day, mindlessly. I mean, all of these habits together, $10,000 over the course of a year. Even if you're just doing the coffee habit, and $270 is about what you're going to spend at Starbucks for a regular coffee. Almost $1,000 to get a cup of coffee every single day during the course of a year. So this is where we have that, oh my goodness moment. What are the other things? What are the things that are more important to me that I could be spending this money on if I curb some of my habits? So what does living within your means and having a balanced budget look like in real life? Because we can talk about saving money and we can think we're on track, and it all comes down to our personal comfort level. One of the things that I learned after graduating with quite a bit of student loan debt is that debt can become a way of life. We can become comfortable with just about anything and accept it as a fact of life and a reality. Don't become comfortable with debt. It doesn't have to be the norm. You don't have to live in debt if you make good choices. So Elizabeth Warren supports, and she has been, I guess she was the first one to kind of coin these ratios and make them popular. The 50-30-20 budgeting guideline. And this is it's not a rule, it's a guideline. It's recommended ratios for how you allot the money that you earn so that you don't get in over your head in any one area of your life. So this is again where we talk about those needs versus those wants. So when we talk about needs, basic groceries, basic housing, anything that you are legally obligated to pay, so student loans, they come under your needs. When we talk about our savings and our debt servicing, so 20%, and this is your take-home pay. So we're saying after taxes, your net pay, 20% should be split between your savings, and that's your savings for retirement. This is savings for your other needs, not for your wants. Should be split between your savings and your debt servicing. So any existing debts over and above the minimum payments that you're obligated to pay, the balance should come out of this ratio here. And then 30% goes towards your wants. So this is going to be your hobbies, your vacations, and have your savings goals for your vacations. They come out of that. So what does this look like in real life? I have a couple. They are both making $45,000 a year. They're living in Delaware County. And joining their two paychecks together, this is what their take-home pay looks like. And when we break it out into the recommended ratios, they're averaging about $5,700 in take-home pay per month between the two of them. Their needs are going to cover $2,870. Their savings and debt servicing is going to be $1,148. And then what's left for their wants is a little over $1,700. The key to managing this is not getting that debt initially, is not already starting behind the 8 ball as far as having too much credit card debt or other kinds of debt. So this is a house that they can afford. This fits in their budget. And this is a real house. This is all the taxes and the closing costs and everything. So now they're going to have had to have saved for that 20% down payment. Otherwise, they're going to have to adjust the selling price of the house to go with whatever they were managing to save. A real mortgage rate, the real property taxes, and the real home insurance. So this house is going to cost them $1,270 a month. Fits in their budget. Well, now they also have to buy a car. And there is a recommended ratio for buying a car. And there's a lot of important facts and figures that go into this ratio. And if you can keep to this, you will be much happier with your automotive purchases. So it's 20% down. So whatever car you're thinking about buying, you should be able to come up with 20% down. The reason why they recommend 20% down is because it's a depreciating asset. The car, once you drive it off the lot, is worth less money than when you initially purchased it. Financing no more than 48 months. That goes back to two different areas of this. The fact that it's a depreciating asset, so every month that ticks by, it's worth less money. So you want to make sure that you're paying down on what you owe quicker than the value is depreciating. The other reason why we recommend going with 48 months is because we tend to fit things into our budget that don't necessarily fit. I can afford this car if I take the financing out 72 months. Okay, well now we're talking about the payment. Fine, you can afford the payment, but what about all the other things that go into having that vehicle? An initial cost that is higher means an overall cost that is higher. So there's a site called Edmunds.com, and I've put some of this information into some of your handouts. Edmunds.com is kind of an all-encompassing car website. You can shop for vehicles, you can get facts and figures, and one of the things that they have in there is a total cost of ownership over 5 years. You would be surprised how you can pick two used cars that at the time are maybe the exact same price, but that cost of ownership for one over the other can be completely different. You know, when you're talking about a $14,000 BMW that's maybe 7 or 8 years old as opposed to a $14,000 Ford, which is maybe 2 or 3 years old, your repairs, your maintenance, your oil changes, your tires, your cost of fuel, you could be paying twice as much in fuel and not even be thinking about that when you're driving it around the lot and trying to decide if you want to buy it. So that's why these are the recommended ratios that you go with. And the 10% rule. The payment and insurance, because believe me, if you've never been on your own insurance policy, you don't realize how expensive it is, especially if you're under the age of 25. Your payment and insurance should be no more than 10% of your gross monthly income. You don't want to be house poor and you don't want to be car poor. So for our couple, their gross monthly income is $7,500. So 10% of that means $750, but we've got two people. So either they're driving one really fancy car, or we're going to have to split that between the two of them. So $375 per month per car. And that includes auto insurance. So if you're living in the city of Philadelphia, that number is going to be a lot higher. Your car is probably going to need to be a lot cheaper. This is what I found for this couple online. This is a real vehicle. So 2015 Honda Civic. It is a certified pre-owned vehicle, so it still has a warranty with the tax because I like dealing with real numbers. 20% down, amount to finance. That is a rate that they would potentially qualify for. It is a real rate. The insurance I got quoted was from Liberty Mutual. It's for a female college graduate of over the age of 30 with a good driving record and a $500 deductible. So again, these are real numbers. They might not be real numbers for you, so you have to take that into consideration when you're doing your shopping. Know how much auto insurance is going to cost you. So I had a member come to me, this was a few years ago, and he was car shopping, and he had never car shopped before. He didn't have his own financing when he went to the dealer, and the dealer was kind enough to help him with everything. Dealer got him auto insurance, dealer got him financing, everything. So he brought his contract to me, and I sat down and I went over everything. The dealer had given him a terrible rate based on his income because the dealer makes money off of that. And on top of that, the dealer had financed a 6-month premium for his car insurance into a 72-month vehicle contract as an add-on. So what that meant is that it was a payment he could afford because he stretched it out a really long period of time, but there was something in there. There was a 6-month insurance premium because some people pay their insurance at 6-month intervals. Some people pay it monthly. So after that 6 months, he's now paying almost $2,000 for something that he's going to have to start paying monthly or pay another $2,000 for the next 6 months. And he hadn't even realized that was going on. So these are the kind of things, you need to be an educated consumer. You need to understand what you can afford and all the different costs associated with any big purchase that you're making. Otherwise, you can be taken advantage of and you could be paying a lot more for something than you should. So this is what our couple's money looks like. Remember, with the car, we were talking about gross income when we decided what our payment was going to be. But on this budgeting guideline, we're talking about after tax. This is what they're actually taking home each month. So, out of this $2,870, we've got $1,270 that's going towards our mortgage and our house taxes. And we've got $370 twice that's going for our automotive and our car insurance and our vehicle. So they have $860 left in their needs budget to cover their utilities and to cover their basic groceries. So we're still dealing with over $1,100 to cover any debt servicing that they have and for their savings. And they have over $1,700 in their budget for having fun, for saving for vacation, things like that. So not living a crazy lifestyle, but living a manageable lifestyle. They're able to be homeowners. They're able to take care of the things that they need to take care of because they have a plan. So one of the things we talked about was an emergency fund. Everybody's first goal should always be to have that emergency fund. And sometimes we hear, oh, your emergency fund should be 6 months of your income. I don't know about you, but I don't know how over the course of a year or two, I'm going to save 50% of my income. It's not a realistic number. There are 2 recommendations as far as what you should save for. There's actually 2 emergency funds. The first one's your short-term emergency fund, and that should either be $1,000 or 2 weeks' salary. And that's for if you have a pet, a vet bill, because vet bills are out of control, a car repair, and a broken appliance if you have your own home, and that's something that you're responsible for. Then we talk about the long-term emergency fund, and this is something that we kind of ramp up to. It's 3 to 9 months living expenses. So this is the kind of thing we save for in case of a medical emergency or a job loss. And the reason that they put that 3 to 9 months living expenses is because it's kind of understood that if you don't have any income or your income is cut significantly, you're going to curb your habits. If you're a reasonably intelligent individual, you're going to stop doing a lot of the things that you normally do when you have income coming in. So we're just talking about the bare necessities, keeping a roof over your head, keeping groceries in the house, keeping the lights on. The 3 to 9 months comes in because of your hireability. So if we're going with the idea of a job loss, if you are in a field that is hot right now, if you have strong job skills, if the economy is strong, if you've been out of work before and it took you a very short period of time to get a job, again, making a reasonably close amount of money or making more money, then you can probably err on the side of caution and go with 3 months living expenses and keep that available to you. That should go in a special savings account so that if you need to tap into it, it doesn't take you weeks to cash out some stocks and have to take a hit that way. If you are in an industry that's maybe not as strong, maybe if the last time you were out of work it took you several months to get back on track, then maybe you move towards that 6 to 9 months. And again, you don't get there overnight. I mean, unless you are already living off of about 25% of your income, and there are people out there who are fortunate enough to be able to do that, then this is going to be probably one of those midterm goals for you. Break it down. Decide how long it's going to take you to get there based on what you have available to you as far as your income goes. And put that money aside. Put it into a special savings account each and every week. Every time you get paid. When you get your income tax refund, maybe that's one of the things. You take half of that and you put it towards your emergency fund, saving for that urgent situation. So, understand that budgeting and financial goal setting is a living, breathing thing. It's not something you sit down and do in one shot. You have to adjust. You have to move forward. Your priorities change. Your situation changes. So you track your income and your spending over the course of a month. You create a preliminary budget. You differentiate between your wants and your needs and your spending habits. See what you can cut out. See what you want to keep. See what's important to you. Then you're going to set some realistic goals based on where you want to be financially. And you have to constantly be reevaluating your budget for changes. Maybe one semester you have to buy some really expensive books. Maybe the next semester that's not something that you need to outlay money for. So then you can adjust your budget accordingly because that's not something that you need to spend money on. So, one of the most important tools besides the budget itself, as far as managing your money, is how you manage your overall finances. And this is where we're going to talk a little bit about Banking 101. So, if you're going to manage your money, you've pretty much got 3 options. You can use a bank, you can use a credit union, or you can be what's called unbanked. And unfortunately, I come across too many individuals who are unbanked. They don't have an account. They're just basically living paycheck to paycheck, cashing that paycheck, and then using money orders. Again, might not be a lifestyle that you're familiar with, might not be the way that you were raised, but for a very large portion of our society, this is how they do business because they don't have an understanding of the banking system or they don't think that they can maintain the requirements of an account in order to have one. So, I touched on this a little earlier. The main difference is we are non-for-profit. Credit unions are non-for-profit financial institutions. We are cooperative. We are here to help our members, and we don't call them customers, they're members. Their accounts are called shares because it's legitimately their share of the credit union. Banks are for-profit. If you are being offered a huge amount of money, say $300, in order to bring your accounts over to a bank, you have to stop for a moment and think to yourself, how are they going to get that and more money back through my use of the account? It costs a financial institution about $300 to $350 a year to maintain a checking account. So now they're adding on top of that another $300 incentive for you to come and do business with them. So there are a variety of ways that financial institutions make money. Some of them are from you and some of them are from the services that you use and you don't necessarily directly pay them. Credit unions and banks are insured up to $250,000 per signer per account. So if you are joint on an account with a partner, then you have $500,000 between the two of you that is guaranteed and insured and backed by the U.S. government. If that financial institution goes out of business, you do have recourse to get your money back. If you go to a check cashing service and you lose the money that they give you or somebody robs you, there's no guarantees. You're pretty much on your own as far as that goes. So let's talk about the cost of utilizing a check cashing service. So check cashing services charge between 1.5 and 10% of the value of the check that you're using in order to make their profits. The average in the city of Philadelphia for a payroll check is about 2.75%. So if you're making $400 a week, you're paying $11 each time to cash your paycheck. $572 a year just to get cash, as opposed to having a bank account, having your check deposited or using direct deposit and being able to just get money out of an ATM. Well, not all your bills can be paid with cash, so now you're going to have to get some money orders. Average cost for a money order is about $1. You can go to the post office or you can go to Western Union at the grocery store and get them. So if you have to pay 5 bills a month, that's another $60 a year. In order to do business this way, if this is what you're forced to do, it's costing you over $600. So over a week and a half's worth of pay every year just to pay your bills. Banks vary greatly. I can't stress this enough. So if you are looking to do business with a bank or a credit union, we are highly regulated industries. From a consumer standpoint, you have the right to know the cost of every single fee before you do business. But what ends up happening is that people don't ask for that ahead of time. They don't necessarily do their research. And then you get handed a stack of about 75 pieces of paper after you sign up for the account that you're expected to go read and understand thoroughly. Because if you don't understand something thoroughly and you get feed, it's on you. And you're probably not going to be able to get that fee waived. So before you make a decision, go online. Look at the cost of everything that you're going to need associated with an account. Monthly fees for checking accounts with a lot of the big banks in the area are anywhere from $3 to $12 per month. That's just for maintaining that account. Now, some of them are going to let you avoid that fee. They might have a minimum balance. Typically, the minimum balance is about $1,500. For some accounts, it's more like $5,000. Sometimes it's a direct deposit. So it's like, okay, cool. I have a job, I have a part-time job, get a direct deposit. One of the large banks in the area, they waive their fee completely if you have a direct deposit. The monthly direct deposit needs to be $5,000. That's the actual amount that has to be going in each month into your account. So if you can meet that requirement, great. If you can't, they're going to be charging you. Sometimes it's a minimum number of debit card transactions. And this is one that seems to be going away a little bit. Does anybody know why they would encourage you to use a debit card?
Because they make money off of it?
Yes. Do you know how? ATM fees? No, but they do make money off of ATM fees. They do make money off of that, but there's, yes?
Each individual business has to pay a certain fee for that.
Exactly. This is one of those dark little secrets that I was already a year into retail banking before I knew about. There's something called the interchange fee, and this is why companies like Walmart are pushing hard to have their own banks. This is why Target wants you to get a red card, because of those interchange fees. They're more than happy to give you a little bit of money off because they don't have to pay a fee to Visa, MasterCard, American Express, and Discover. And it is big business. This is why a lot of small merchants don't want to use credit cards. They want you to spend a minimum amount of money, maybe a $10 minimum. It's because every time you swipe that card, the merchant is paying, and that payment is split between the bank that issues the card and the Visa or MasterCard network that the purchase is going through. It's very short-sighted for merchants to discourage that behavior because as somebody who's been on the retail banking side and had to talk to merchants about this, they estimate that you as a consumer will spend on average 20% more at a store if you can swipe a card versus only being able to use the cash in your pocket. So you spend more money. And the more money that goes through that interchange network, the more money in the pocket of your financial institution. That's why they want you to use that card. When you go through the ATM network and you do a PIN transaction, the merchant does not have to pay for that. That is costing your bank or your credit union money, and they typically discourage those behaviors or they limit those behaviors. So, average ATM fee for using another bank's ATM. So I'm just going to throw names out there. These are not necessarily numbers attached to these names. So if you use Wells Fargo and you are not using a Wells Fargo ATM, you're using maybe a Citizens Bank ATM, you're going to get charged by Wells Fargo for using that other ATM, and you're going to get charged by Citizens for using their ATM. So what would normally be a $2 or $3 charge could now be a $5 or $6 charge. If you go and you use Wawa, they're owned by PNC, the ATMs there. PNC has an agreement, they will not charge you. That doesn't mean that your own financial institution won't charge you. Many do. So don't think that it's a free ATM if you're going to then get hit with that on your statement. Know the cost. This is, I think, just absolutely shocking. So 5 of the 7 largest banks in our area will charge you for a paper statement. You know, you brought up the fact that you should be looking at your statement every single month. You should be looking at it as often as possible. You only have a 60-day window in order to report a fraudulent charge. So 5 of the 7 largest banks are going to charge you anywhere between $1 and $3 to get that statement if you're not willing to go online and look at it. So let's say that you are using a bank that's costing you $3 a month. That's the cheapest one you were able to find. So $36 a year, okay? Still cheaper than our check cashing service. You're using someone else's ATM once a week because when you go, you get your direct deposit, you still need to get cash and there isn't a convenient ATM for you. So now, because of that $5 a week fee, you're spending $260 a year in ATM fees. So now you're spending a total of $296 because of this choice. And if you have to get paper statements for whatever reason, I mean, I don't get paper statements, but if that's the way you choose to have them, now your total is $332 a year for making this choice. So that's fine if you're willing to put up with that. Make sure you're aware of it. We as a credit union don't do any of that because, again, we are non-for-profit. There are a lot of credit unions that take this behavior and promote it. One of the other things is that cooperative network that we have. So police and fire is very big in the city. There are other credit unions that are big in the city. So our members can go to their ATMs. Their members can come to our ATMs. We don't charge fees. A lot of our technologies we share. It keeps costs down and it becomes a benefit to our members. It helps everyone grow. That's what we're here for. So why would you need a checking and a savings account? Well, they have two different purposes and they have different functions. A checking account is a transaction account. You should not have automatic purchases, swipes, anything coming out electronically from your savings account. It's a dangerous place to be. You are limited by the federal government as to how many electronic pulls you can have out of a savings account. You're limited to 6 per calendar month. It's Federal Regulation D. So if you only have a savings account and you're having things pulled out of that and you're using that on a regular basis, first of all, you're really not saving. It's a transaction account at that point. And second of all, you really risk getting additional fees because you don't understand how the account works. You should have a checking account. You should have goals associated with your savings account and have your money coming into your checking account and have a portion go into your savings account every time you get paid so that you can hit those goals. So, when you're looking at accounts, a lot of you may be eligible for a student account. There are several banks in the area that offer that. If you're, I believe it's 23 is typically the cutoff for that. So they give you everything for free, and it's very convenient. But make sure that you know how much that account is going to cost you when you turn 24. Because what ends up happening is that we get used to things. We get comfortable with our behaviors and using these accounts. And banks and credit unions encourage us to get more and more involved. They want that direct deposit. They want all your accounts to be sweeping in and out of your checking account. Because the more entrenched you are in doing business with that financial institution, the more difficult it becomes to change when you're unhappy with something. Before you go and use any of the services for a financial institution, know the costs. Know how much it's going to cost if you want to use that ATM over at Wawa or 7-Eleven. If you're out of state and you have an emergency, how much is that going to cost you? Are you going to be able to get a hold of your money? Are there minimum deposit amounts or auto deposit requirements to waive a fee for your savings account? Most of the banks will charge you for a savings account because savings accounts cost them money. They don't make money. You don't have those debit card swipes. You don't have the overdraft charges. Overdraft charges are huge. You had brought those up. So one of the things that most people don't realize is that if you bounce a check or if you overdraw your account, you go negative, there's a charge for that. It's typically $35. That tends to be the charge across the board. Many organizations have what's called a sustained overdraft charge. So let's say it's the beginning of your pay period and you're paid every 2 weeks. You go negative day 3 of your pay period. So now it's going to be another 7 days before you get paid. Most institutions will charge you, typically after 4 to 5 business days, they're going to charge you another fee for being negative. Some of them charge you a fee every day after that also. And this is not something that any banker is going to want to sit down and have a conversation with you about before you come aboard, because it's not fun stuff to talk about. It's things that are going to potentially hurt you. So they don't want to even address it. But that is all outlined on the schedule of fees before you sign up for an account. Be aware, because that can cost you a lot of money. Some of them cap it at $90, but if you are living paycheck to paycheck, you make a mistake, something comes through that you weren't anticipating, and now you potentially are going to rack up another $90 in fees to go negative. That can be very painful. Understand how they're going to post things. So there are 2 different philosophies with posting things. So At midnight, your paycheck hits. At midnight, they process all the checks that came through, all the transactions that came through on your account. They could post things, your credits first, and then your debits large to small. The thinking behind that they would like to promote to you is that, let's say that big payment's your mortgage or your rent. We definitely want that to go through because that's going to be a big problem for you if it doesn't go through. But if that cleans out your account and then you have all these little charges come through, well, at least the important thing, was paid. Well, the other way to look at it is, if the big things go through first and sweep out and clean out your account, then they can charge you an overdraft fee for every little thing that comes after that. So that's another thing to take into consideration when you're managing your money. Understand how they're processing their fees, how you're going to get hit, what's your recourse. So, what are your needs and your habits? Are you choosing a financial institution that's going to serve your needs? Can you qualify for direct deposit in order to have fees waived? Can you meet the requirements for minimum balance in order to have fees waived? Are you young enough to have the fees waived? You have the right to know the cost of services before you choose a financial institution. Don't forget to be a wise shopper with everything that you do. Know the overdraft charges because these are the ones that get most of us. I can't tell you when I was in school how many times I got hit by overdrafts because I wasn't paying as close to attention as what I should have been doing. And are you going to get charged for having a savings account? A lot of times the savings account is free if you have a checking account and you have money automatically going into it. But are you able to do that? Are you able to get a free checking account? Because if you have to pay for your checking account in order to get a free savings account, is that going to erode any savings that you're actually able to put into it? This is my contact information. If there's something that we touched on that you're unsure of, if you're not comfortable asking a question, you're welcome to email me. I would be happy to send you information. I will answer your questions. Does anybody have any questions about the things that we've touched on today? Well, thank you very much. I appreciate your time. We have an office right here at 3200 Chestnut. If you have any questions about the credit union, what a credit union is, we're more than happy to help you. Izzy, who is one of your fellow grad students, is also one of our employees. He works with me, so he can answer direct questions also if you see him on campus. Thank you very much, everyone. Appreciate it.